Welcome to Thoughts on the Market. I'm Andrew Sheets, Chief Cross-Asset Strategist for Morgan Stanley. Along with my colleagues, bringing you a variety of perspectives, I'll be talking about trends across the global investment landscape and how we put those different ideas together. It's Friday, April 24th at 2 p.m. in London. In the midst of the current public health crisis, there's a temptation to assume that investors are facing something unique and that historical patterns no longer apply. But we disagree with this notion. As unusual, uncertain, and unsettling as the current environment is, key elements of the business cycle, we think, remain intact. We believe strongly that markets lead the economy, not the other way around, and that history suggests that recently weak economic data can actually support higher 12-month returns for credit and lower levels of market volatility. When thinking about the business cycle, we find a couple of notions helpful. First, that the economy is cyclical. It moves in waves, as caution and underspending usually give way to optimism and excessive spending. That excess then leads to recessions, and those recessions reset the economic cycle, starting the whole process again. It all sounds simple enough, but with thousands of possible economic indicators, trying to model that process can easily become noisy and overwhelming. At Morgan Stanley, our cycle indicator is based on 10 large key metrics for the U.S. economy, which have tended to be leading. This simplification of the economic cycle in aggregate can be broken down into one of four possible stages. This data can be either better or worse than average, and it can be rising or falling. And those four potential phases, or seasons, if you will, of our cycle indicator are the four possible outputs. Such analysis of this model makes two things clear. First, markets regularly lead the economy rather than the other way around. For example, buying stocks when economic data is weak, but prices are low, has consistently produced better returns than buying when economic data is strong, but prices are high. Second, there are very important patterns in the way that cycles interact with market performance and different asset class leadership. Credit spreads and market volatility often start improving before equity markets do, and do so even as the economic data is continuing to get worse. And I think there's some logic to this, as tough times can make companies more conservative, benefiting their bondholders over their stockholders. Meanwhile, it's very possible and common for economic data to worsen even after the peak of economic uncertainty is behind us, a reason that market volatility can fall even as data remains weak and a recession lingers. Thinking about this cycle is an important part of our investment process at Morgan Stanley. But it's especially relevant today because the models we follow have just had an important change of signal. From the middle of 2019 until last week, they were in the phase we call downturn, when the data is better than average, but it's no longer improving. And that phase is generally associated with worse than average 12-month returns for stocks and corporate bonds. But last week, the model changed. Data's still getting weaker, but it's now worse than average. And that new phase, which we call repair, has historically meant better returns for corporate bonds and lower levels of market volatility. We are overweight on corporate credit in the US and Europe, across both investment grade and high yield. Thanks for listening. For more video from Morgan Stanley, please subscribe here to our YouTube channel, or you can subscribe to Thoughts on the Market directly on Apple Podcasts or your favorite podcast platform.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.